Welcome to The Explainer. You know that feeling when you're looking at a company's financials, you hit the tax footnotes and your eyes just completely glaze over? Yeah, you're definitely not alone. But stick with me here. Today, we're decoding one of the most intimidating, jargon-heavy parts of corporate financial statements, the income tax provision. We're going to break down exactly how these numbers are built, why they are so incredibly volatile, and what they're actually telling us about a company's real financial health. So, picture this. A company announces its quarterly earnings. Revenue's up, operating margins are rock solid, but then, bam, their earnings per share completely mess analyst expectations. Why? Because their tax rate unexpectedly spiked. Or, on the flip side, maybe they absolutely crushed earnings because their tax rate plummeted to near zero. These sudden, violent movements can literally terrify or thrill investors. So today, we're investigating the primary drivers causing this volatility. We're going to pull back the curtain and see exactly what's pulling those levers. Here is our roadmap for today. First, we'll demystify the tax rate itself. Second, we'll look at the valuation allowance. Third, we'll dive into uncertain tax positions. And finally, we'll build out the final provision.
All right, let's jump straight into part one, demystifying the tax rate, also known as the public report card.
Now, the metric everyone completely obsesses over is the effective tax rate, or ETR. The formula itself, super straightforward. It's just total income tax expense divided by GAAP pre-tax income. But here's the thing. For public companies, this ETR reconciliation is essentially a highly scrutinized public report card. It bridges the gap between the statutory U.S. federal rate, which is 21%, and the company's actual reality. If a company's ETR is wildly above or below that 21%, you better believe investors and analysts are going to demand answers. They want to know exactly what is skewing the math. And that brings us to the usual suspects. Here are the specific drivers that just yank the ETR around from quarter to quarter. We've got valuation allowance changes, which can cause massive one-time swings. Then there are enacted rate changes. This is when the government literally changes the tax law, meaning you have to do an immediate remeasurement. We also have stock compensation excess tax benefits, which bounce around based on the company's stock price. And finally, prior year true-up patterns. Now, this list sets up our whole deep dive today because we're going to focus on the absolute biggest, most complex culprits right here.
Let's move into part two, the valuation allowance and the weight of evidence.
Okay, so this is our first major driver of volatility. When assessing deferred tax assets, which are basically tax benefits a company hopes to use in the future, like carrying forward past losses, it's a strict balancing act. Accounting rules actually dictate that you have to establish a valuation allowance, which is essentially writing down that asset, if it is more likely than not that you won't realize that benefit. Now, more likely than not means greater than a 50% probability. To figure this out, management and their auditors have to weigh things. They place positive evidence on one side of the scale and negative evidence on the other.
So, what exactly goes on the positive side of that scale? Well, the accounting standards identify 4 specific sources of positive evidence. Number 1, future reversals of existing deferred tax liabilities. 2, management's projection of future taxable income. 3, taxable income in carryback years, if that applies. And 4, tax planning strategies. But listen, there is a massive catch for number 4. Those tax planning strategies absolutely must be specific, prudent, and actionable. Management can't just daydream about some hypothetical pivot that magically generates billions. It has to be a feasible action, like selling an appreciated asset or restructuring an existing agreement.
Now, on the flip side, the crucial point is this specific piece of negative evidence right here, the cumulative 3-year loss position. If a company has lost money over the last 3 years combined, this acts as a heavyweight anchor on the other side of our scale. It's literally the strongest single negative indicator out there. In fact, it's so strong, it creates a presumption that a full valuation allowance is required. To overcome this 3-year loss position, you need incredibly strong, highly specific positive evidence. And you can absolutely bet that auditors and the audit committee will subject this to immense scrutiny. This whole balancing act is exactly why investors care so deeply. Just think about the income statement impact. If the valuation allowance decreases, meaning the company finally has enough positive evidence to release the allowance, it creates this huge, favorable, one-time tax benefit. The ETR plummets, and boom, earnings shoot up. But conversely, if negative evidence mounts and they have to increase that allowance, that's an unfavorable additional tax expense that severely hurts the bottom line. It's a massive lever on corporate profitability. Which brings us to part 3, uncertain tax positions under FIN 48. So, when dealing with uncertain tax positions, meaning tax return positions the IRS or other tax authorities might not fully accept, a company can't just recognize the full benefit on their financials and cross their fingers. No way. They have to cross a specific recognition threshold. There must be a greater than 50% probability that the position will be sustained if the tax authority examines it. This is a strict all-or-nothing binary gate. It's not a probability-weighted average. If a tax position only has a 40 or 45% chance of surviving an IRS audit, the company recognizes absolutely zero benefit. The full tax has to be accrued as if the position completely fails. But once a position actually crosses that initial 50% gate, well, the math gets really interesting. Accountants have to measure the largest amount of tax benefit that successfully clears the hurdle upon settlement. It's a four-step process. First, they identify all possible settlement outcomes with the IRS. Second, they assign individual and cumulative probabilities to each of those outcomes. Third, they work down the list to find the exact point where the cumulative probability crosses 50%. And fourth, they recognize the specific dollar amount associated with that exact threshold. It's honestly a fascinating exercise in probability and risk assessment.
The thing is, these uncertain tax positions don't just stay on the books forever. There's a ticking clock known as the statute of limitations. For most general items, the IRS has exactly 3 years from the return due date or filing date to challenge the position. If there are substantial omissions, meaning more than 25% of gross income, that clock extends to 6 years. And in cases of fraud, there is no statute. It just remains open indefinitely. So why does this matter for the financial statements? Well, because the very moment that clock runs out and the statute lapses, the position is effectively settled. The company reverses the reserve they've been holding, and suddenly a favorable tax benefit hits the books, completely dropping the ETR.
All right, Section 4, building the final provision, the 5 components.
So the total income tax provision is actually a recipe made up of 5 distinct components. First up, the current tax. That's what you actually owe based on taxable income right now. Second, the deferred tax, which is the change in those future tax assets and liabilities. Third, our volatile friend, the valuation allowance change. Fourth, the uncertain tax position change, which reacts to new reserves or expiring statutes. And fifth, the prior year true-up. This is the difference between what was estimated in the provision and what was actually filed on the final tax return. These 5 layers sum up perfectly to equal the total income tax expense. Then we just divide that by our pre-tax income to get our final effective tax rate. Now, right before we wrap up, I really need to sound the alarm on component number 5 with this quote. Large prior year true-ups indicate a weak provision process. When analysts and auditors are looking at these 5 components, a consistent pattern of large prior year true-ups, and it doesn't matter if they're favorable or unfavorable, is a massive red flag. It essentially broadcasts to the market that the tax department's original estimates are just consistently wrong. If you see this happening year after year, you can be absolutely certain it's going to trigger intense investigations by both the CFO and the external auditors. The pattern itself is just as revealing as the actual dollar amounts.
And that brings us to the end of our investigation. You see, the income tax provision isn't just some boring math problem at the bottom of the income statement. It's an incredible reflection of management's optimism, their risk tolerance with the IRS, and the overall strength of their internal processes. So my challenge to you is this. The next time you're reading an annual report, don't just skip past those tax footnotes. Ask yourself, what story is the ETR reconciliation really telling you about management's assumptions? Look for those valuation allowances, check for those true-ups, and use your brand new understanding to decode the true story behind the numbers. Thanks for hanging out, keep analyzing, and I'll see you on the next explainer.